Terry Smith is often called Britain's Warren Buffett. His fund, which is called Fundsmith, has generated a 600% return since it was founded in 2010, which has dramatically outperformed the market for years. And his fantastic book, Investing for Growth, distills decades worth of investing wisdom into 10 practical lessons that every investor should know. In this video, I'll share 10 of the most powerful lessons from that book that will permanently change the way that you invest. Let's kick it off with lesson number 1, which is to focus on business quality above all. Smith believes that buying high-quality businesses at fair prices is a superior strategy to buying fair businesses bought at great prices. So that raises the question, how do you determine if a business is high quality or not? Well, that's a nuanced answer that he discusses in more detail in the book, but there are some shortcuts that we can use. When reading through Smith's book, it's clear that there's a few key metrics that he focuses on for businesses to tell if they are high quality or not. So what are those key metrics? Well, the first is called return on capital employed. This metric shows how efficiently a company converts capital into profits. Smith wants to see that this number is above 20% for the companies he's invested in. Second number he looks at is gross margin. This figure is gross profit divided by revenue, and Smith wants this number to be over 50%. The third number he looks at is operating margin. This figure is operating profit divided by sales, and Smith wants this number to be over 20%. The fourth metric is called cash conversion. This metric measures how much of a company's net income gets converted into free cash flow. Smith wants to see that this number is over 90%. And then the final number he looks at is called interest coverage. This number compares a company's interest expense to its earnings before interest and taxes. Smith wants its numbers to be well over 15x to show that it can easily handle its interest burden. Now, if you look at his portfolio and judge it by these 5 key metrics over the last decade or so, you'll see that in every single year, his portfolio has exceeded these targets, while benchmarks like the S&P 500 and FTSE 100 simply do not. That shows that on average, Terry Smith invests in much higher quality companies that can be found in the S&P 500 or FTSE 100. That brings us to Smith's second lesson, that is, investing doesn't have to be complicated. In fact, complexity is usually the enemy of good returns. Smith argues that buying simple, easy to understand businesses beats chasing exotic strategies. In his portfolio, you'll find easy to understand businesses like L'Oreal, Brown-Forman, and Philip Morris. These companies have straightforward business models that are very easy to understand and analyze to tell if the thesis is on track or not. Smith's third lesson is that the best investment opportunities are often hiding in plain sight. These are obvious investments that you don't have to turn over a ton of rocks to find. Smith argues that many of the world's best investments are behind businesses that you use every single day. And he's made a fortune investing in companies like Microsoft, Visa, and Meta Platforms. These are companies that everybody has heard of, yet they have still produced sensational returns for their investors. So there's no need to go hunting for undiscovered or uncovered gems when there are so many obvious great investments in plain sight. As a side note, I made some visuals that summarize the key investing lessons of super investors like Warren Buffett, Terry Smith, and Peter Lynch. If you want a free copy of those infographics, simply visit longtermmindset.co/superinvestor or click the link in the video description, and I'll email you 10 visuals that break down the most important investing lessons of all time. Now, for lesson number 4, Smith stresses that the best businesses in the world are the ones that consistently generate predictable cash flow in both good times and bad. Now, cash flow is what actually pays dividends, funds reinvestment in the business, and give companies resilience in tough times. Think of cash flow the same way you do your personal finances. If you have a steady paycheck coming in every month, it's a lot easier to plan ahead than if your income swings wildly back and forth. This is why Smith looks for businesses that sell goods and services that are essential to everyday life and whose profits don't wax and wane based on the business cycle. Now, Smith's fifth lesson is crystal clear. Do not try to time the market. Smith points out that even professional investors fail at this task, even though it seems simple from the outside. Now, Smith references a visual in the book that shows how if you miss just a handful of the best performing days in the market, then your long-term returns absolutely collapse. As this visual shows, between 2003 and 2022, if you missed out on just the 10 best performing days in the market, your overall return would be cut in half. Now, what makes investing so challenging is that you never know what the best days are going to be ahead of time. In fact, if you you look at the best trading days over the last 20 years, you'll find that nearly all of them occur during volatile times for the market, such as 2008, 2020, and 2009. These periods were marked by high volatility when it is most tempting to try and trade since the market is both collapsing and rebounding in rapid fashion. Smith points out that trying to time the market is a game for losers, and it's a much better strategy to simply remain invested. Now, lesson number 6 is about avoiding over-diversification, which is something that I myself have struggled with for years. If you own too many stocks, it waters down the returns of your winners and makes your portfolio behave and look more like an index fund than an actively managed portfolio. Now, as this visual shows, Smiths think that the sweet spot is to have between 15 and 20 high-quality businesses, and studies show that that is enough diversification to take away most of the company's specific risk, but not too many that makes managing a portfolio overly burdensome and will just take your returns down to the index level. That brings us to Smith's 7th lesson, which is very counterintuitive, and that is to not be afraid of buying companies that have already won for their investors. Smith argues that just because a stock has already gone up a lot doesn't mean it can't keep compounding for investors. In fact, most dominant businesses can stay dominant for decades. So a great strategy is to look for businesses that have already won and hop on the train, betting that they'll continue to win moving forward. We've seen this time and time again with great businesses. Take Visa as an example. Visa was already a huge winner by 2015, but even by then its stock was still a tremendous buy because it was such a high quality business with such strong growth potential ahead. If you bought it late in 2015, you still earned sensational returns. The same thing can be said about great businesses like Stryker, whose stock was also up huge by 2015, but continued to have a great run ahead. And we've also seen this happen with companies like Google, whose stock was also up big in 2015, yet it was still a tremendous buy at that time. So don't be afraid to buy stocks that have already gone up a lot. More often than not, that's a positive sign for investors instead of being a negative one. Now, Smith's 8th lesson is all about keeping perspective. Smith argues that you should not watch stock prices every day. The more you watch stock prices, the more you'll be tempted to trade, and trading hurts returns. Smith argues that instead, your focus should be on the long-term progress of the businesses you own and research in potential new investments. Smith says that you don't check the price of your house every morning, but you still know that it's increasing in value over time. Think of your stock portfolio the exact same way. Now, Smith's 9th lesson is to invest in products that people keep buying no matter what. Smith says that buying businesses with strong brands and built-in repeat demand is an incredibly powerful combination. Think about great businesses like Coca-Cola, Colgate toothpaste, or Nestle's chocolate. These aren't one-time purchases. They're staples that people buy again and again and again, even during hard times. That gives these businesses predictable revenue, predictable growth, and predictable profits to share with their investors. Now, Smith's 10th lesson might be the hardest for most investors to do, and that is to do less. Smith points out that the best results often come from buying great businesses and then leaving them alone. Activity can feel productive, but in investing, patience is what really pays. Smith points out that activity can feel productive, but in investing, it's patience that really pays off. Smith says it's kind of like planting a tree. You don't go dig it up every week to check the roots. You want to give that tree time to build out the roots and just have faith that it's building value in the background. You want to water it, give it time, and let compounding do the heavy lifting for you. Now, Smith believes in this principle so strongly that he built it into the company's core investing strategy, which is one of the best investing strategies I've ever heard. That strategy is to buy good companies, don't overpay, and then do nothing. And oftentimes, it's that last part, do nothing, that's the hardest thing for investors to do. So that closes out all 10 lessons from Terry Smith's great book, Investing for Growth. I highly recommend you pick up a copy and read the entire thing. It is a truly fantastic book. And as a reminder, if you want a visual summary of these lessons, plus the most important lessons of other super investors, just visit longtermmindset.co/superinvestor, and I'll email you a free copy of my PDF ebook that has these lessons laid out visually. Thanks so much for watching. I hope you enjoyed this video. If you did, give us a thumbs up on YouTube. If you want to keep learning from other super investors from here, I highly recommend you watch this video next.